Hi everyone, Sheena Hansen here with Uncommon Sense Investing, coming at you with another episode of our Frequently Asked Questions series. And today I'm going to talk about how you can help your either child or grandchildren invest for the first time. So there are really three different account types that are my favorite account types to invest in for grandkids. But before we tackle that, I want to just kind of mention that with investing, it really is a long-term type of endeavor. So if you're thinking about putting money in the market, it needs to be for a long period of time to be able to realize the benefits of that. So you might have kids or grandkids that also have short-term cash needs. Maybe you need to think about going to the bank and opening up a savings account for the first time, possibly attaching them if they're a little bit older to a credit card, help them build credit. One thing that I'm doing for my kids right now, they're turning 7 and 9 here in the next couple of months, and we have debit cards. So there are parent controlled debit cards where you can easily transfer money in and out, and it kind of just gives them the feel for handling cash for the first time. But today we're talking about investing long-term money and for their future. So my favorite types are the College 529 plan, the UTMA, UGMA account for minors, and the Roth IRA. They all have different features, different tax consequences, and I wanted to outline the different characteristics of those account types for you here. Let's make this a little bigger so we can see it, if possible. Okay, that's a little bit better. So really the columns here, we want to talk about the purpose of these various account types, the different tax benefits, who has ownership and control, and then if there's any kind of usage restrictions. So let's kick it off with talking about the 529 account. As is in the title of the plan name, it is for college. So, that's one, for some people, drawback. Not every child goes to college or different higher education. And so it is earmarked and pigeonholed for that one purpose. There's more tax benefits associated with this type of savings. Money that gets deposited into the 529 account can have tax benefits on the front end, possibly state tax deductions or even credits depending on the state. And then as that money grows over time, it grows tax-free. On the back end, when that money gets withdrawn for those college expenses, it's also tax-free as long as they're qualified. The owner of the account is the custodian or the parent, I should say, or grandparent. And then listed on that 529 account type then is the minor beneficiary. So the usage restriction for that 529, like I already mentioned, it does have to be for college education, or there could be penalties applied on those withdrawals if they're not. One thing that recently changed that I think really makes 529s more attractive and less restrictive is the fact that if a 529 is held and owned for at least 15 years, it is possible to move and transfer some of those funds into a Roth IRA. So no longer is it so restrictive, and there's a little bit more flexibility there on the back end if you've had that account for a long time and you want to potentially help fund a Roth IRA if that child or grandchild does not go to college. There are other variables of that, lifetime maximum amounts that can be transferred to a Roth IRA. And so if you're considering, just definitely look up those rules. Let's move on to the UTMA UGMA account type. It is a custodial account. It's really used for general investment purposes. So there's a lot of flexibility. You can use that money to help maybe pay towards a car for a 16-year-old. You can use it for college. You can use it for anything really, as long as it benefits the minor. It is a taxable account. So unlike the 529 account, it does not grow tax-free. If you have this type of an account, you would get a 1099 at the end of the year and report taxes that might be owed on interest or capital gains that may have paid out throughout the year. Typically, taxes are paid at the child's tax rate, but there are thresholds on that. And so if the account gets large enough and there is enough interest and dividends and capital gains that get paid out, it's possible to have that taxed at the parent's tax rate. This account type is owned by the child. It gets placed in their name and their social security number, and then they get to control it completely once they reach the age of majority. So there's no restrictions. This is your most flexible account type for a minor. And then finally, we have the Roth IRA. It is a retirement savings account, but a powerhouse of tax benefits. It grows tax-free. Qualified withdrawals in the future are tax-free. And this account too is owned by the child. In order to qualify for having a Roth IRA, they do have to have earned income. So I typically see people opening these accounts at the very earliest once that minor has their first job and they're earning part-time income. Maybe they are working in the summer and they earn a few $1,000s throughout the year. Well, that's a good opportunity for them to open a Roth IRA. And when kids are young, certainly they have a lot of expenses and not so much in assets. And so frequently, as a parent or grandparent, you can make the contribution on behalf of your child, but they have to have the earnings. It can be fun too to incentivize them. Maybe if they put in a couple $100s, you'll be able to match them or put in a additional sum, and just kind of make it an educational opportunity as well. So these are the accounts that are mostly used for minors. You don't have to necessarily just pick one. You could open multiple accounts for different reasons. I personally have 529 savings plans for my kids in addition to the UTMA custodial account, just to offer more flexibility and to get the tax benefits of the 529. So they can complement each other as well. One thing I wanted to drive home about the 529 plan is that for Wisconsin, you really would want to open an account through the state plan EdVest, because contributions that get made to an EdVest plan are state tax deductible. And it is per person per beneficiary. So as this illustration shows, this one beneficiary, Megan, she could have potentially 3 people making contributions in her account throughout the year, a parent, a grandparent, a family friend, whoever wants to. And the maximum amount for this year anyway is $5,130. That does change, typically increases from year to year. But if each of those people contribute on behalf of Megan, they each get their own state tax deduction. So that is attractive. And then here, just to comment on the age of majority for those UTMA, UGMA accounts. The age of majority does vary by state. In the state of Wisconsin, the age is 21. So if you open an account for your grandchild or your child and you're saving, you're putting money in there, in Wisconsin, once they turn 21, you're going to want to re-register that account, get your name off there as the parent or grandparent, and officially get that titled to the minor, because, well, they're no longer a minor in the state. So there's really no restrictions other than kind of the fact that there's this age of majority, and the minor fully takes control at this point. So that's it. If you have other questions about potentially opening up or starting a 529 plan, a custodial account, that UTMA account, or a Roth IRA for a minor, certainly let me know. Happy to talk through those options a little bit more. But they're great. The saying goes, it's time that really matters in terms of compounding with your investments. The earlier you start, the better. And this is a great way to do that. Thanks for tuning in.